I'll just tell you right up front, I do not think the market has put in a bottoming formation. There's just not enough evidence for that, and I'll prove it to you in today's episode. But a rug pull, I'm seeing much more of a trend continuation opportunity versus a straight up flash crash. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, we have a green inverted hammer-esque style bar where, of course, in the upper wick, sellers certainly stepped up and they were able to push prices back down towards the opening print, but the weekly bar closes over the opening print, hence the green-bodied bar. We still have a pretty sizable lower wick, though, relative to the size of the candle body, certainly, which does still mean that there was some range expansion to the downside relative to the open back on Monday, of course. Now, I would really classify that as neutral to bearish on structure, but location is really the nail in the coffin here. Of course, on the bar-to-bar count, notice that we do have a substantial higher low, but this is where it gets interesting. We did breach the previous candle's high for a higher high, but where did we close? We closed back inside of the previous week's range, as well as underneath the weekly 50 SMA, and that to me is the bearish tell, because the weekly 50 SMA is the bottom end of the do or die zone that we've been talking about on the channel for the past couple of weeks. So structure paired with location now brings me up and over the edge, and I would just say, yeah, the weekly chart certainly looks more bearish than it does bullish. We could also just read into this through the lens of, hey, if the previous week's range or structure was a hammer candle, breaking the hammer high, in theory, should bring in more buying pressure, right? We have this long lower wick because buyers stepped up near the lows. If they're going to continue off of that momentum from the lows for a counter trend move in the upward direction, probably should have seen a little bit more follow through to the upside to at least test, in my opinion, the neckline of what we've been talking about as a double top, right? You can see we have left and we have right, and we didn't even see a full retest of the double top neckline. So to me, a bearish inverted hammer with bearish location closing inside the previous week's range, underneath the weekly 50 SMA, underneath the do or die zone low, really doesn't look like a strong bottoming formation at all. If we come in here with the Fibonacci's, we can just quickly take a look from here up to the all-time high, and we know that we held the 61.8 basically right to the tick, so that's fantastic. But notice that the upper wick of this previous week's bar is a rejection underneath the Fib 38.2. A stronger bottoming formation probably should have seeked price acceptance back over the Fib 38.2 such that we could start looking at this through the lens of perhaps a look below and fail. That just didn't happen, and we're still stuck here in no man's land. So bottoming formation, I'm not seeing it from a Fib perspective. Let's come in from the high to the most local low, and what you'll see here is that we're still also underneath the Fib 38.2. So what does that mean from this point of view? That any consolidation underneath the Fib 38.2 classifies as bear flag consolidation. Certainly doesn't sound like a bottoming formation or look like a bottoming formation in my view here from the weekly point of view. Let's take a look at the anchored VWAP spreads. We are supporting here above one of the anchored VWAP spreads, but let's just look at some of these more local ones. Certainly underneath a majority of the cluster. And if we anchored one to the all-time high, we'll see this with the intraday spread in just a moment, we're underneath that as well. So all of these just really represent an opportunity coming from the lowest low on the weekly trend count to set some sort of lower high rejection, which keeps the trend down on the weekly time frame chart. Once again, does that sound like or look like a bottoming formation? I'm just not seeing it. Let's take a look through the volume profile lens and just be really thorough in our interrogation here. Let's drop this down to maybe just 2 years worth of price action so we don't have all that space. And let's extend this high volume node right here. What do you notice about that? The upper wick is a rejection of that high volume node. We've closed underneath. That certainly sounds and looks more bearish than it does bullish. Buyers probably would want to see a recovery over that level, some sort of acceptance above to then establish a volume base and then complete the rotation for the look below and fail. That's not what we have with the upper wick on the weekly bar. I just want to take this time as well to remind people that I don't want to have to be any more bearish than I have to be. The chart is telling me to be bearish here based on the observations that we've really just walked through together, really. So let's take a look at the daily time frame chart, see if anything changes from this point of view. We'll begin with the weekly expected move, which is in this box right here. If you're not familiar with that study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 574.92, and to me, that still qualifies as a daily lower high in the overall trend count. I'll just remind you that literally from the all-time high to the lowest low of this downdraft, we have not seen a firm daily lower high. To set a firm daily lower high, you need the hourly trend to flip to up. The closest we got to that was in here, coming from the lowest low of the move and gapping up on that large red-bodied bar's open. That's the closest we got to an hourly uptrend, and even that was iffy. It was questionable because it was really set via the gap up, right? So this is possibly like a soft lower high on the daily trend count, which means, and I hate to be this guy, and of course it comes with a majority of other complications, but what this means is that a daily lower high can be set anywhere underneath 595.85. Now, of course, if we rally here, any pullbacks could easily then start to suggest some sort of higher low. That's what I meant by it comes with complications, and we don't want to go down that rabbit hole just right now. But the point being is the upper edge of the weekly expected move for this week is certainly still well within the confines of a lower high, a firm lower high on the daily time frame. Because, of course, in here, we've finally achieved some sort of hourly uptrend. We'll talk about that in just a moment. The lower bound of the weekly expected move is at 553.02, basically an equal low down here. The reason I said in the intro, I'm maybe not convinced that it's just going to be an outright rug pull, is because we're not sitting flat across the lows. We don't have this big flush point that's developed. To me, it just looks like trend continuation in the downward direction. So why might I say that? If we look at the Monday session bar, we close over the do or die zone low. Tuesday technically gets a little bit of follow through underneath, but then promptly fails on Wednesday, which was the FOMC rally, late day. We get sort of this breach back over Tuesday's high in the do or die zone low. So you would think, okay, sellers are starting to fail here. Let's try to use this opportunity as a higher low and launch out of this do or die zone, which is still this orange box right here. The upper bound of it is the daily 200 SMA. The previous two equal lows from back here, that's 573. There was no launch up and over that. We did not test last week's upper edge of the expected move. We did not bring in any semblance of a higher high. As a matter of fact, if we look at Wednesday's upper wick and Thursday's upper wick, both of those wicks, to me, would indicate that new money buyers are pretty tepid around those highs. And if anything, it looks like a rollover rejection underneath the daily 200 SMA. So on Friday, we do have to concede the point that on the gap down, once again, sellers were unable to find follow through there. On a gap down in a downtrend, I would have thought that that could have been an opportunity for sellers to create some sort of equal low to finish the week, or just produce some sort of very clean gap fill reversal underneath the Thursday low, and that simply didn't happen. So I do want to acknowledge here that the Friday bar is not all that compelling for the shorts to just be stepping up right here, right now, looking for that follow through to the downside. We did close inside of Thursday's range, which is not, again, a strong indication that new money sellers are participating on some sort of lower high that they're confident in yet. So going back to the intro and the title of today's video, rug pull, I'm not fully seeing that, but we're definitely not out of the woods here from a daily downtrend being in force. So this, of course, inevitably leads to the question, where will we start thinking about a daily uptrend? Where will we start thinking about this as a firm bottom being in the market? Well, I hope that we could all agree and come to the same conclusion that at minimum, we would have to be over the do or die zone high. You've got to recapture the daily 200 SMA. This can no longer act as a lower high in the trend count. So if this to this is going to act as a higher low, then I would need to see consolidation up here this week and then some sort of break and higher high. And I've been very, very clear, I hope, in my expression of this thesis that I need all of the components of an uptrend if I'm going to call this a structural bottom, because we just do not have a capitulation style flush where emotions have taken grasp of the market and oh my God, everybody's freaking out, and that is when a capitulation style bottom, a V-shaped recovery can take place. We don't have that. This has been pretty solid two-sided trade back and forth, bearish two-sided trade nonetheless, but it has not been capitulation. There is no V-shaped recovery. We can't have confidence in a bottom based on emotion. We need to have confidence in a bottom based on structure. and we're just not all the way there yet. We would need to see some sort of higher high outside of the do or die zone high at 573. So that's my take on the daily time frame. We did technically close Friday underneath the do or die zone low, so I still am very much a believer that a lower high is in the cards here. There's nothing really all that compelling to say this is a structural low. That's it. The bottom's in. Time to move higher. Of course, there's a little bit of an OPEX pin taking place perhaps through the week. Jerome Powell volatility was happening through the week, so I think we'll learn a little bit more about the ebbs and flows of the market, so to speak, earlier on this upcoming week than what we had for price action last week here. That's what we've got, of course, to the downside. Excuse me, just to give you a little bit of an idea about the downside targets. If we make the move back down to the equal low, which is really 552.15, give or take, if we get back down there, remember that this is a thin structure retracement to get there. And then beyond that, it's a range rotation into the lows here at 541.25. There's a little bit of an unfilled gap from this area, and then the next level would be way down here at 529. I'm not forecasting this, of course, this week, but it's just levels to have on your screens as we remain, in my opinion, in a still very volatile market. Any final commentary here on the daily before we move along? I do want to check in relative to our election gap, and this will become a little bit more clear as to why on some other charts that we'll check in on today, but we're underneath the election gap, which in my view still classifies all of this as overhead supply. It's very difficult to make that bullish, compelling argument that a bottom is in structurally. We don't have the proper components of the trend count, and we're still underneath a lot of local overhead supply. It's not like we've been trading below this for months now and a stage one base is formed, not even close. That's the daily analysis. Let's drop it on down to the hourly. Let's see what we can learn from this point of view. We've got quite a few helper levels inside of this range, but if you want to keep it simple, underneath 565.50, I would be thinking about rotations to the bottom end of the range. Ultimately, that's 552.15 that we were just talking about. Lower edge of the weekly expected move, 553 give or take, and then of course those downside levels we were just referencing. If we're thinking about the price action here, there's been multiple chances for buyers to firmly accept over the do or die zone low. We've really refined the level to key off of this previous Friday. So let's just draw this flat across the top. Here on Monday, buyers recaptured the level. You would think if new money buyers, if a strong bottoming formation was going to be here, and I know this is very similar to the daily analysis with the upper wicks we were just talking about, but you would expect that the hourly uptrend would try to find buyers above and then get continuation in the upward direction. Okay, we didn't. We fell back down into range, but at least we can say that the look above and fail actually failed because we broke back out again. And this could be construed as the next higher low in the hourly trend count. From here to here, you have a little bit of an hourly higher high. So awesome, we've satisfied the conditions of an hourly uptrend, but lo and behold, we're back underneath the level. So what happens now is the sellers have a look above and fail on their hands. They have it again. It happened here on Monday. It happens here on the Thursday session. Friday opens on the gap down. Once again, stronger sellers really would have gone gap and go, found that follow through to the downside. Stronger sellers also should have gone gap fill reversal, close weak near the opening print, rejecting the Thursday low. That didn't quite happen, but we're certainly nowhere near finding a higher low over the do or die zone low at 565.50, which is my key point here as to saying that it just looks like trend continuation. It looks like a rollover here to me to the downside, seeking some further bearish pressure. You could also take the approach that on the hourly time frame chart, perhaps this is a double top and this is your neckline, and we're just looking for either a right shoulder to make this sort of a maybe left double top, head, right shoulder. Maybe it's a head and shoulders, right? Under the neckline, regardless, at 559.75, your helper level there should open the door towards the bottom end of the range. 552.15, once again, is your level. If we were to see some sort of follow through to the upside, there's nothing wrong with scalping this in the upward direction, but I would still keep my thinking cap on. Sure, you can go risk, reward, that's fine. You probably want to respect the Thursday high, the Monday high, the Wednesday high, the Jerome Powell pump high. You want to respect those things, but so long as price is underneath 573, it's just a great opportunity for this, and then show me the reversal back down, show me this, show me the rotation, and the bears remain in control. If we get this sort of consolidation and a hold, and then we also get the higher high over the top of 573 as described on the daily time frame chart, that is where I ultimately have to change my tone and say, okay, we do have some sort of higher high. And I would just make the comment one more time. I think I've once again been very clear about this. I don't want to be more bearish than I have to be. When and if a structural low is established in the market on the daily time frame chart, I don't care if I'm air quotes late to the party by entering up here. I would prefer the confirmation. And generally, we're not just looking for an equal high at the all-time high. We're looking for continuation of the bull market over years to come. So being late, air quotes, by patiently waiting for confirmation does not strike me as being an issue. It strikes me as actually being a compelling argument to say, okay, let's be open-minded to further downside and not jump the gun on trying to catch a falling knife that's still in the process of falling. Gravity has not been turned off yet. It's still moving in the downward direction. Let's go back to the hourly time frame chart. Let's take a look perhaps at the intraday anchored view apps. You've heard my commentary. You know my stance. I'm willing and open to change my mind on the trend here, but I don't think we have the evidence. Here's the all-time high anchored view app I was talking about on the weekly perspective. That is still where we're seeing rejections. This would have been the upper wick of the weekly bar right here, still rejecting well below that. You'll notice that we're tangled up in this cluster. If the low is going to hold, if this is ultimately going to be it, I would love to see price acceptance out here above the cluster of anchored view apps. Let these act as support underneath us and continue to push price in the upward direction. As of Friday's close, we're kind of just in the midpoint of the entire cluster. If we reject this, I think the door is open underneath the anchored view apps, underneath that 559.75 helper level, the double top neckline, if you will. That's where the door opens right back up to the downside, and we're aiming for the equal lows, if not follow through for a lower low to continue the daily downtrend. Let's move along to the market internals and see what else we can learn about this market. If you're not familiar with the internals, check out the video tutorial in the top right-hand corner. On the Friday session, when we got that counter trend rally, right? It was pretty much a day of counter trend rally all day intraday. Where were the volume flows? They were technically out of the market. The breadth here opened up horrifically. It was one of the worst reads we've seen in a very long time. You can see that the opening 15-minute close there, sorry, not the opening, but the 10 o'clock bar closes at negative 8.2 to 1 on the nicey breadth. We've not seen that in a very long time. That, to me, is not indicative at all of new money buyers stepping up. If we take a look at the advanced decline line, it was near trend lower zone on the open. It climbed a little bit, but it didn't make it to the zero line. It's still negative to close the day. If we look at the cumulative build out of the tick, it's still negative even though the market trended in the upward direction. And remember, this measures from the previous day's close, so we'll give it a break there. This measures from the previous day's close, we'll give it a break there. The tick measures literally on a tick by tick basis. If the market was trending higher, I would think across the exchange, if new money buyers were really stepping up to form this structural low, you would have seen far better improvements out of the Friday session. It would have looked more like Monday. This is not the case at all. So internals not really supportive of a big bottom being placed in the market as of right now. Market profile. We just talked internals. Market profile. Too many things to cover here. What do we have in the top right-hand corner? It's the video tutorial if you're not familiar with this. Let's take a look at where value is on the Friday session. You want to talk to me about a market that's accepting higher prices? Then don't show me a market that finds value clearly lower than the previous day's session. Point of control certainly lower. The close was up here. You have an M period spike that we'll be dealing with on the Monday open. You have a poor low on the Friday session. This is not indicative of a low, once again, in my opinion. So market profile references also suggest that, yeah, there was a little bit of a counter trend move on Friday, but new money buyers, structural low, it's not looking like it's in the cards here. Everything still suggests that the sellers have the edge on the market profile. Let's take a look at the QQQ and see what's happening from the NASDAQ side of the market. We'll go out to a weekly time frame chart. We'll see what else we can glean about these markets that we are trading. On the QQQ structure, what do we see? Weekly bars, a little bit more doji-esque rather than inverted hammer-esque. The lower wick might actually be a little longer than the upper wick. Regardless, signals indecision to me, so we'll say neutral on structure. Location is the same, though, as the S&P 500 with that higher low as well as the higher high, rejecting the upper wick. Outside of the previous week's range, of course, but also the weekly 50 SMA and closing under the 50 SMA inside of the previous week's range. Not really a compelling argument that a bottom is in play here, but perhaps slightly stronger than what we had in the S&P 500, just purely based on the size of the lower wick, but still not a market where I'm like, oh yeah, let's go out there and buy it with both hands, right? We're clearly still in the throes of a trend reversal with the double top here, not even a full retest of the neckline, plenty of opportunity for a weekly lower high after setting from here to here, a weekly lower low. There's no possibility of a weekly trend change over the span of next week's candle unless, never say never, there's some sort of weekly bar that does this and instantly goes from lowest low to highest high. I don't know about you, but I would prescribe certainly lower odds to something like that taking place. If we're thinking about the Fibonacci's, we'll see a lot of rinse and repeat here relative to the S&P 500. We are respecting the 61.8. We've even rejected lower on the QQQ NASDAQ. You can see the 50% fib rejecting instead of the 38.2. If we come in from the high down to the low, well underneath the 38.2, and just a great reference to understand that these are stacked together at what I would argue was where we were really trying to give the NASDAQ the benefit of the doubt for so long, was like, okay, we're still technically holding up over this level. I don't want to become a bear any more prematurely than I have to. It's not there. Look at this consolidation underneath. There's so much room for a lower high in the trend count. Let's take a look quickly through the NASDAQ weekly anchored VWAPs. You'll notice that we closed underneath this one instead of above like the S&P 500. So all of these are barreling down on price, once again offering an opportunity for some sort of weekly structural lower high. The volume profile, on the weekly time frame chart, 2-year chart will be fine. Where are we relative to this high volume node? I was hoping that I could say, oh, look, maybe there's something bullish to say. Nope, we are underneath the high volume node, rejecting it in the upper wick. We'll still say that the lower wick is a little bit more compelling than the S&P, but general location here out of the weekly bar, not really building the case for a stronger bottom in the QQQ NASDAQ 100. Let's go to the daily time frame chart. Let's firstly evaluate this week's expected move. It's this box right here. The upper bound is going to be at 492.50, which is great confluence with previous levels that we had back in here, as well as off to the left, it's that election gap. So when I was saying earlier on, let's take a check-in on the S&P 500 election gap, it's really because in the NASDAQ, it's such a critical place where there's still an opportunity for a lower high. The do or die zone is not really as well defined here on the NASDAQ as the S&P 500. However, if we're just thinking about the range that's in force down here, did we get any acceptance over that Friday low? I wouldn't really, call it acceptance. A little bit of a cough today. You get these upper wicks very similar to the S&P 500, very, very small close on that Friday session over the level there. So it's still all about 480.25. I would still be thinking about this through the lens of bear flag consolidation. We clearly are still in a daily downtrend with the opportunity for a lower high. And I'd be looking at this level right here at the 492.50. If there is a continued counter trend move here this upcoming week, this is just a place where on the weekly perspective, the daily perspective, I would really continue to keep that open mind saying, what are the chances for some sort of lower high to emerge here, push price back down? Ideally, it would be some sort of break back into the range to the equal low. I will change my tone on the QQQ NASDAQ when and if we get the push to here, higher low, and the higher high. Once again, I hope I've been very clear in my expectations for the market, but I will change my tone from a trend count perspective when we have all of the components of a newfound uptrend, higher high, after a higher low pullback from what is still a threat as a lower high in the daily trend count, of course. Those are the concepts here. Don't really think we have much else to describe. Maybe we'll check in on some downside levels just to be aware of them. I'll continue to bring this up, and we mentioned this in last Saturday's update. This is thin structure. The S&P has retraced that thin structure, right? The NASDAQ looked underneath it in a number of weekly bars, not this past week, but the week prior, especially on that Friday low closing underneath this shelf. The fact that the NASDAQ did not accelerate with new money sellers really pressing the bet this week underneath that level, the fact that there was a no thin structure retracement does lead me to believe at least a little bit that we want to keep that semi-open mind to two-sided trade down here, not just an outright rug pull. It does appear as though sellers could be classified as being slightly tired on the lows of the move. Now, once again, it does not look like a structural low. This does not look like a bottoming formation yet, but the sellers do appear to be slightly tired, and we could make the same comment about the Friday gap down here in the QQQ as we made in the S&P 500. Stronger sellers should have gone gap and go. Stronger sellers should have gone gap fill reversal. Stronger sellers should have just closed underneath the do or die zone low at 480.25. You can clearly see none of those three outcomes took place. Sellers, a little tired. Let's take a look at the hourly time frame chart. We won't sort of rehash all of the same things, but if this is going to be a double top, you would have ideally liked to see it break down underneath the neckline. That didn't happen. That number is at 473.25. We'll still monitor that as a key area. What you could start to do here is honestly, instead of this being the range, the reason it's like that is so we can just talk about how this failed to find acceptance above, failed to find acceptance above, but the New Balance range that's really in play here, and hashtag sponsored from New Balance, I wish, is this box right here. So don't be shocked if in the Wednesday midweek market update or through the duration of this week, we update the thick versus dotted lines to being this range right here, because this is really what we're going to start caring about. Thinking back to the title of the episode, thinking back to rug pull versus structural low, we've been quite clear about no structural low, but rug pull, I mean, this maybe starts to become a rug pull if you were to get back down there, but Friday didn't really suggest that. And even if you do break down through this, we're thinking about these equalos acting as potential support, so more like trend continuation still is the outcome that I'm seeing. That's the base case here on the hourly and daily combo, which of course is in the downward direction. Any other big things to share on the hourly? Let's check in on the intraday anchored VWAPs above the cluster, whereas the S&P 500 was more so inside of the cluster. So one of the trades that might be really lucrative early on in the week is just consolidation here. Brigade bolt above gives you the counter trend, looking for the rejection when and if we make it there, trying to trade back down into the top end of the range here, or perhaps the top end of the updated range at 484 would be the target as well. If we bounce and make that higher high, we change our tone, but the base case for now would suggest that this probably it's the more probable thing that I can see based on all of the supporting evidence. But we'll keep an open mind. We don't want to have more of a bearish stance than we need to have, right? I'll continue to reinforce that point too. So hopefully this walkthrough has been helpful on the NASDAQ and the S&P. Let's quickly check in on the NASDAQ internals. What do we see over here? A little bit better volume flows hitting the zero line. If we take a look at let me see if I can hide that real quick. This is yes it is. Just making sure that this is the NASDAQ breadth ratio histogram, it is, and we still did get bearish reads off the open on Friday, but notice that they're not nearly as bad as the S&P 500 or the NYSE exchange. They're down negative 3.1 versus negative 8.2 on the NYSE, which is quite telling. A little bit of a counter trend move coming out of trend lower zone, but really not a compelling difference here on the advanced decline line, and still a negative cumulative build out of the tick. If we take a look at the market profile, what do we see over here? A little bit better of a shift, value moving slightly higher in the individual session, as well as point of control still lower relative to the Thursday session, but higher in the individual range. We will have this M period spike to take a look at on the Monday morning open. Spike rules basically tell us if we open in the spike, we are looking for support off of the base and continuation in the upward direction. If we open over the spike, we're expecting just the auction to continue in the upward direction. And if we open underneath the base of the spike, sayonara, that is a rejection, that is a failure of this end of day rally. We should expect lower prices to retrace back down towards the bottom end of the balance. Let's get back on over to the platform. Let's finish up the broad market here with none other than our good friend, the Rusty Russell. IWM on a weekly time frame chart. What can we see? Let's take a look at a clean drawing set. Candle structure and location. You definitely have yourselves a bearish inverted hammer. Check that thing out. You've got much more of a substantial upper wick than you do lower wick, and unfortunately, I guess it's not as bearish as it could be. A red-bodied bar would be worse, but we still have all the same elements location-wise as the other two indices, right? You have a higher low technically and a higher high, a little bit more meaningful of a higher high. So frame it this way, right? The buyers actually did make a decent effort to try to break out of the previous week's range, and that effort failed. We closed back inside of the previous week's range. Let me zoom in a little further on that for you. Closed back inside the previous week's range, well underneath the 50 SMA on the weekly, and back down towards the weekly 200 SMA. I would remind you guys that we are dealing with a head and shoulders here instead of a double top. We've been well underneath the neckline for a number of weeks now, and this, as a counter trend move, it looks exactly like that. It does not look like a bottoming formation. It looks more like a potential lower high that's well below the neckline of that pattern we just described. We know that 200 is still an interesting place for the small caps. If I grab actually more than 3 years, let's try a 5-year chart. Yeah, that's much better. We know that this is still a compelling place on like the monthly time frame chart, but the weekly still has no indications yet of a trend reversal, with that inverted hammer bar we just described and the location being the key component. So if we're over 200, maybe we're a little bit more neutral here. We're not continuing to expect as much bearish pressure as it's possible that some sort of base gets built, but I would not change my tone prematurely until we start to move away from that base more meaningfully in the upward direction. So that is that. Let's take a look at the anchored VWAPs on the IWM. You can see that we are still supporting this in the lower wick of not last week's bar, but the week prior, and we're actually rejecting in the upper wick the lowest low anchored VWAP here. If I zoom in a little on that, you can see price was unable to close over that. If we check in on our Fibonacci's from the top to the bottom, of course, well underneath the Fib 38.2, let's come in from the shoulder to the low, and this is also underneath the Fib 38.2. So still bear flag consolidation, no matter how you slice the cake there. Let's check in on the volume profile, and we'll leave the multi-year chart on here, the 5-year, just so we can see where this overhead supply is. I mean, clearly that's really, really strong as volume commitment overhead that's continuing to weigh on price in the downward direction. But I would just reinforce that the top end of the range is also a high volume node down here. So we're sort of caught between a rock and a hard place on the IWM higher time frames. Don't get me wrong, the chart doesn't look inherently bullish, but it is a logical place where if, keyword, and we'll put an asterisk here, if buyers are going to step up, it would seem reasonable that this is the place at 200 here out of IWM. Let's take a look at the daily time frame chart, and this is important, right, because the IWM will act as a tailwind or headwind for the S&P 500. As we take a look at the daily time frame chart, let's zoom in a little bit further. The weekly expected move shows us that we're still thinking about lower highs. This is not over this last area back here. This is not really an hourly uptrend. It was an inside range bar there before breaking down. This, of course, is more of an hourly uptrend. So we're seeking a lower high anywhere underneath really this 214, which keeps us bearish on the weekly time frame chart. Anyways, the upper edge, of the weekly expected move, 208.82. It's confluence with the top end of that inside consolidation. The lower edge, the weekly expected move, just like the other two indices, is at the bottom end of the move. Equal lows there, 198.70 is your number. Now, I can already envision it, right? Everybody in the comments, hey, look at the inverted head and shoulders. Just like all of the other indexes, I would need to see a stronger break for all of the components of a new uptrend, meaning, so yes, sure you have left, sure you have head, sure this right starts to build out, that's fine, but show me a higher high, show me some sort of breakout over this after we pull back to hold this definitively as a higher low at 204, and then maybe we'll consider it. Don't forget, we have the weekly lower high threat at 214, but if we don't want to remain too bearish, right? We at some point, a structural low will take over, but there's just not been capitulation, that V-shaped recovery conversation we were having prior. The 214 can still act as a weekly lower high because the weekly downtrend is much more severe here out of small caps relative to something like the S&P or the NASDAQ even. If we're thinking about the structure, this is actually much more of a bearish structure on Friday. We gap down, we set a lower low instead of sort of just rallying out of the gates, and then notice that we do not close over 204. We do not close inside the Thursday range. It's more of a gap fill reversal. So sellers actually have something going on here in the IWM when we're actually considering the bar to bar after multiple stronger relative to the other two indexes, the stronger closes that we've seen above the 204, right? Let's go down to the hourly time frame chart. Let's see what we can glean from this perspective. We can all see the possibility of the inverted head and shoulders again. That's fine. But this, I think, is what we want to focus on for a moment. Just the fact that on the Friday session, the upper wicks really started to reject for that gap fill reversal. So any consolidation here, actually in the short term, I would argue is regular head and shoulders under the neckline. There's your flush point. There's your flash crash. There is your rug pull. Out of the IWM, it seems a little bit more clear at 202.40. Underneath that level, rotating through this thin structure here into the bottom end of the range at 198, which is kind of that weekly key zone one more time. So maybe button up the shorts down here and just, don't maintain such an aggressive short stance. If you're short from up here, the risk reward makes sense. If you're trying to find a new money short here at the weekly area of support that we were just looking at, the top end of that monthly range, risk reward might become a little bit harder to pull off. That would not be my favorite place to initiate a new money trade. If it's going to be bullish, yes, you have to get over 204, put in this consolidation. We'll concede the point we're building out that right shoulder, but you have to get me up and over this 209.25. Show me this. Show me that higher high. I'll change my tone. For now, does not seem like a top priority given what we just walked through with the lower high rejection underneath 204. If this was going to be an uptrend, lows, higher lows, maybe even higher lows here. If you want to count Thursday, you had highs, you had higher highs, so on and so forth. There's your hourly uptrend. That trend is broken via lower low here to here. If this lower high sticks, we are looking for downside to align back with the daily trend in the downward direction. Let's check in on the intraday anchored VWAPs. Let's see what we can see here. Rejecting or sort of closed in the cluster, if you will. Still an opportunity for resistance there. What about the Russell side of the market internals? What do we see here? No strong volume inflows. They're, as a matter of fact, closer to the strong volume outflows area. They were not underneath, but fairly close. If we take a look at the advanced decline line, not over the zero mark, and the cumulative build out of the Russell tick was really not that compelling either. All week, it's been very bearish, regardless of the intraday price action. Let's check in on the Russell futures through the lens of market profile. What we see here is a point of control that slammed up towards the top, but remember, it is a gap fill reversal. What I would really pay attention to here is if we were to break underneath these lows, right around in here, this is now trapped overhead supply. Anybody who bought the small caps on Friday, which clearly is indicated by this point of control drift to the upper end of the range, those traders are trapped. So it doesn't matter, long or short, whoever has the edge there, right? Put yourself in the shoes of the trader. If you're long and we break down through the lows, obviously you're trapped. You're feeling like this. If you're short, you're feeling like this. So it doesn't matter if you want to sit here and tell me, no, those are new money shorts in the point of control, or no, those are buyers, they're new money longs. If we break down under these lows, doesn't matter, it is going to align more so with follow through psychologically in the downward direction. So there's that. Let's take a look over at our S&P sectors. Let's start to get a little bit more granular. Let's see what's going on here. And let's see what we can do. In terms of the weekly performance of the sectors, who was leading, who was losing, where was the weight? Energy, financials, healthcare, the top three. The bottom end of the barrel is semiconductors, as well as staples and utilities. Really not down all that much, only 65 basis points at the worst. That's the semiconductors there. And energy up 3.16%. Not really going to move the needle. Energy's just been stuck in this really wide range. I'd say it's compelling that the financial sector is up 2.34%, and really what this snapshot tells me is two-sided trade rotation is still taking place in here. It's not that we have capitulation to the downside, so we should not be looking for a V-shaped recovery like what we have back here. We need that structural low to be put in place before I start touting the bullhorn again and I get called the perma bull of YouTube on the way back up. That's fine. Let's take a look at these structural charts and see what's going on. Energy still inside of this very wide and volatile range. I don't think there's anything that we want to read into there. Financials, to me, still have the threat for a potential lower high. We're underneath the daily 50. We're underneath this overhead supply. Yes, this is starting to look a little V-like. It seems to me with some of these upper wicks rejecting with the lack of price acceptance above 49.60, it seems like a decent spot for a lower high. If the market rolls over, I think the next big tell for whether or not a structural low will ultimately be established in the S&P is whether or not financials hold on a pullback over 48.25, the top end of this consolidation range here. If this takes place and we're at the equal high, I would be a little bit more optimistic about saying, hey, I'm more than happy to say that I was wrong about the low not being in place. If we get this right here, I would start to become a little bit more optimistic, as I've said, about the S&P. Of course, if we rally a little bit further, I would not discount the idea for a lower high rejection at 50.70. Let's move along to healthcare. Healthcare is heavier weight, fourth heaviest weight sector now, but it's also D for defensive. Has it done anything interesting? The answer is no. It's inside the consolidation range. It'll be more compelling when it breaks for a higher high or a lower low outside of this broadening formation that it's actually in, broadening wedge, something that looks like that. Let's move along to communications, finding a little bit of a floor temporarily at this area, but just like all of the other charts we've looked at today, doesn't look like a structural low to me. It looks more like bear flag acceptance on these lows. It looks like even if it rallies a bit further, it could set a lower high up against 99.15 and roll back over to the equal low. I don't think we're out of the woods here yet on the XLC. If we were to do something that looks like this, fine. Again, I'm more than happy to say when I'm wrong, and I will be glad to admit when I'm wrong so we can get on the right side of the trade, but that has to happen first, and it just hasn't happened first or yet. Let's take a look at industrials. Industrials look like maybe structural reversal happening here over 134 early in the week, and we would sort of have our answer. I actually do like the hammer here. So again, I let the chart tell us what is happening. I like the fact that this lower low is an excess low. It's not flat straight across the bottom. I like the fact that there's the possibility of this higher low, hammer candle even in force on the Friday session. It would be better if it was over the 200 SMA, but we'll let that slide for now. I think a break of the neckline, and all pattern traders should agree, should bring in a little bit more of a reversal. Now, unfortunately, the XLI is only something like 8%, or maybe it's even less than 8% these days of the S&P 500, so it'll help, but it's not going to move the needle all that much. It really starts to boil down to discretionary and the tech sector and financials when you're looking for a cleaner picture of what the S&P should be doing. If we look at the XLY discretionary, this is back in that same category of like, here's some flat lows. This is just a consolidation range and a bear flag underneath the daily 200 SMA. There's so much room for a lower high, no matter how you slice the cake here. Again, if we have to produce a structural higher low, that's fine, and we'll change our tone when the time is appropriate, but for now, it's lower highs. We are singing about lower highs until we are proven otherwise. Let's move along to real estate. Skipped one in there. Real estate midpoint of a maybe not broadening formation, depends on if you want to call it like that. When it makes a new pivot high, pivot low, we'll be more interested. It's a lightweight sector. Let's move along. XLK, the heaviest weight sector, over 30% of your S&P 500. So you want to talk about something that moves the S&P. It's, of course, tech. We can see that these flat lows represent the improper end of the auction, that's for sure. I will say that the buyers appear to have done something a little bit more impressive as opposed to less impressive, with the gap down not resulting in the follow through to the downside. A lot of the same commentary as the QQQ analysis, of course, closing inside of Thursday's range over Thursday's close and over this key level here at 212.75. If the XLK can get this follow through into the next overhead level, then yeah, I mean, we're talking about the probabilities of the S&P going for the counter trend to the upside being increased. What the XLK does, the S&P should likely follow. So if this is the case with the close over 212.75, maybe we'll keep an open mind to upside sooner in the week, unless this just promptly fails. Lower highs in here, just kiss it goodbye. Kiss it goodbye, equal low. Because this is so poor in terms of structure, I would expect that to break under 206.40. You're probably looking at 203, if not lower than that, pending any volatility. Let's move into the semiconductors, which performed the worst on the week, relative performance there. Looking at the structure, if this can hold a higher low, maybe we can start talking about inverted head and shoulders. Maybe we can start having that conversation about a structural low, but this 237 is your do or die. Look at the overhead supply. We do not have that capitulation style bottom. We're in a downtrend. We are well off of these highs, these highs, these highs. Lower highs everywhere. You can see the Wednesday upper wick, equal high to Monday. Rejections on Thursday, not making as equal of a high there. And then, of course, closing underneath Thursday's range on Friday. So 219.50 will be an early tell this week, whether or not buyers or sellers are in control. If we're above, I would tend to think, okay, maybe that right shoulder is building out. We'll keep an open mind. If this is underneath Friday's low and testing, I would start thinking about, okay, yes, absolutely looking for more bearish pressure out of the S&P as a whole. Moving along to the XLP, talking about consumer staples, consolidation underneath a key over under level. If you just divide the range, of course, you have your top 50%, your lower 50%. Underneath has to be slightly more bearish than bullish. If we take a look at utilities, not much to comment on here, sideways in the range. TLT, right shoulder here, if it is going to be inverted head and shoulders, bring me home over 93, and we'll start talking about a stronger collapse out of interest rates and seeing whether or not small caps participate in any sort of relief rally on lower rates. If that doesn't happen, ding, 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 we have to start talking about the R word again, recession. Let's move along to XLB materials, the lightest weight sector we have. Didn't make a new swing low on the gap down. I think if we're going to equate this to anything, maybe we go XHB for home builders, and we just continue to drive home the point that the cyclical side of the economy, it's clearly in a downtrend. It made lows, lower lows. This is maybe a higher low on Friday's gap down, but it was unable to close the gap. Yeah, buyers stepped up near the lows, but we're underneath a pretty major area of support, or previous support at least, out of this chart here as well. Under $100.50, it's not really looking so hot. We could also use some proxies for risk on, risk off, just in the spirit of checking out some things outside of the 11 sectors. Here's retail, as in like retail spend, retail stores, basically. Just not seeing much here. So again, cyclical side of the economy, not really doing so hot. And then XBI might be a proxy for risk taking, obviously requiring quite a bit of funding for those different stage whatever trials. And, you're taking a pretty big bet there. It's all R&D, research development. Doesn't really look too compelling. I mean, yes, it's sideways down here, but where is it sideways? It's sideways underneath an overhead range block. It's underneath another overhead range block. Is it just building out another stair step to the downside? To me, until proven otherwise, the answer is yes. So some proxies for risk on and risk off outside of the 11 looking a little bit more bearish than they are bullish. Let's move into the sector ratios, see what's going on from this point of view. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This is flat. I would give it the benefit of the doubt, saying it wouldn't be unreasonable if it broke out over this flat top here this week, but in the context of what? An overall downtrend. So I still have to give this an X, unfortunately, trying to remain unbiased. I'd love it if it broke out and was like, yeah, let's rock and roll. But that's not what we're dealing with. Financials definitely look good. They look good on a hold here over, or loosely near, you could say, this retest level, trying to make it back up to the equal high. So we'll actually put a check mark there this week. Unfortunately, discretionary doesn't look good. This is D for defensive. So although, yes, it looks like bullish consolidation, doesn't really move the needle all that much. This is looking okay out of communications. This still looks like risk off, and this certainly looks like risk off with utilities flatlining after a pretty big push to the upside, not even seeing a more substantial pullback there. Let's move along to our specialized ratios. Not seeing anything that's risk on, not seeing anything that's risk on, not risk on, not risk on, and not risk on. So one more time, doesn't matter how you view the market right now, I'm not seeing the short-term indications that a structural low or a more enthusiastic risk-on rotation is taking place. And oh my God, the market's going to blast off to highs. Let's skip right to gold because this is falling into that category as well in terms of risk-on, risk-off, risk appetite. Gold still looks defensive, outperforming the S&P, kind of just going sideways up here. But look at the chart. I mean, there's no issues relative to the actual trend that we're in there. And just in the spirit of staying in risk-on, risk-off, look at TLT. Same thing. TLT ratio to the S&P is also not really signaling, hey, everything's great. Let's jump into equities with both hands, buy this thing. It's going back to new all-time highs. We just don't have that. If we get a little bit more fundamental, we can move into the dollar here. The dollar seeing a little bit of a counter trend this week, but relative to this large breakdown, it's still the same concept of money coming out of U.S. markets and going back, air quotes, home to their domestic markets. Generally, the German market saw a pretty big spike in yield over there, so those things become a little bit more attractive for that domestic currency. Same thing with the Japanese yen, of course. We've been talking about the yen carry trade a little bit as all of these things take place. And just as proxies, let's come in here and say 6E for the euro. This will act maybe as our German proxy, if you will. That's the big push that we saw there. And yeah, there's a little bit of a counter trend, but it doesn't look like money's suddenly just flooding back into the US markets for, hey, let's go get better returns over there. And we can go over to the 6J as well for, of course, our friends in the Japanese yen continuing to just produce its minor uptrend here. This is the panic August 5th. I'd say that this is a substantial enough move in the counter trend direction where it's at least maybe a conversation point, but it's probably not the end-all be-all story at this particular moment in time. Taking a look at our own domestic interest rates here on the TNX, a little bit of an uptick there with the TLT moving lower on the Thursday-Friday session post-Fed, but generally, have we done anything outside of this range? The answer is no. Remember that it's my belief the market priced in everything that it thought appropriate based on all the tariff news and all the trade war stuff through this downdraft here, and now anything that happens in this range is not meaningful until we actually get a break back to the equal high, or we start to see some follow-through back down towards these lows. Rates would have to come down to like 3.7 on the 10-year, which seems like miles away, but given the speed of the rally to the upside here, maybe it does happen sooner than we think. Look at this breakdown back here, right? August 5th panic. Maybe. Never say never in the market, but for now, rates are not really helping or hurting markets, I would say, at this point, in terms of their immediate price action that happened this week. Let's take a look at the inverted ZT to get a sense for the Fed tracker tool. Backing off here continues to suggest that we're still expecting some rate cuts this year. Let's actually jump over to the Fed tracker tool here and see what is going on. Looks like the next meeting, which FYI, there is no April meeting, so we'll go out to May 7th is the next one. We have an 85.7% chance of another pause during that meeting, which is fine, but then we get our first rate cut, second rate cut, third rate cut, all happening here in 2025, which is interesting because if you've been tuning in, we've been covering this. The SEP that was released on Wednesday, March 19th at 2 o'clock from the Fed actually outlines that we should only be expecting 2 rate cuts in 2025. So the market pricing in 3 here is sort of interesting and maybe speaks to the fact that the market is calling Jerome Powell's bluff about this number up here, saying, yeah, we don't know if we believe you about that GDP, only taking a hit, only air quotes, to 1.7. We don't know if we believe you about unemployment rate being revised higher to a 4.4. Inflation got revised higher to a 2.7. That doesn't really feel that good. Same thing with the core. I think the Fed tracker tool pricing in the 3 for 2025 is like, we're going to price in a little bit more help from the Fed than maybe they're willing to admit, because of course they just can't admit it right now. If they were to come out and say, we think that it's going to be a really rocky road and buckle up, we're heading in a recession, markets would drop like a rock. You just can't say that, being Jerome Powell. So we'll read between the lines for him. Let's take a look at the economic calendar from last week. Here's your unchanged rates. Jobless claims towards the end of the week, Thursday morning, came in sort of near expectations, really not seeing anything breaking there yet. This is interesting, of course, because Jerome Powell cited, there's regional weakness from the labor market, but it's not national, or it's not nationwide. It's not a big concern yet for us to step in as the Fed and intervene. A little bit of an uptrend happening here, but still well underneath some threshold levels, which we know are closer to like 235. Heck, if we want to just like really round out the numbers, you could just say blanket statement 250. As long as you're under 250, nothing to worry about in the labor markets, and we just have not seen those style reads yet. Let's close that up and take a look forward at this upcoming week. I think it's very important that we pay attention to on Monday, 9:45, manufacturing and services PMIs. They're the flash numbers, which are usually more important than the final. It's the market's first taste for what's happening on that side, and the PMIs recently have been very telling for the market. In the past, maybe we care more about CPI, PPI, but PMIs recently have been very, very influential over intraday volatility. So please be aware that on Monday, you're headed straight into a PMI response at 9:45. So if you're swinging anything over the weekend, you get a gap or whatever, some sort of move in your favor, you've got 15 minutes before news comes out. Now, of course, you've got to manage your own risk. I'm just telling you that there is an event 15 minutes after the market opens up. It's up to you what you do with that information. A lot of Fed speak next week here, really not much else going on. Durable goods might be interesting, especially if we're thinking about the recession theme. Are those orders drying up or not? GDP, recession theme, typical jobless claims, PCE, inflation on Friday. We'll have coffee and donuts up in the penthouse for that on Friday. However, don't expect a huge reaction from the market. The market's done a pretty good job, I'd say, recently of pricing in based on CPI and PPI what the PCE should come in as. Once the market has both of those data points, can make a pretty well-educated guess as to what PCE will look like. I do want to talk about FedEx, who reported earnings after the close on Thursday. FedEx was one of the names, or one of the companies, I should say, that really rang the warning bell before the 2022 drawdown really got aggressive. And of course, they can see this, right? They, of course, are dealing with shipping as a proxy for showing us, or showing anybody really, what the economy looks like in terms of is our physical products moving places? Is this just an information economy? What's the industrial sector looking like? And if we scroll down here, you can actually see that they lowered their full year guidance for the second time in 3 months, citing a challenging operating environment, and that the citing a challenging environment in the third quarter that isn't expected to improve anytime soon. So you're like, okay, what do you mean not anytime soon? Well, if you read on and come down to here, this is from the CFO. I think it's reasonable to assume that the macro environment is not going to substantially improve significantly, at least through the first half of fiscal 26. The first half of fiscal 26, which of course, depending on when they start their fiscal calendar, it could be, it doesn't actually mean like January 2026. But nonetheless, that's a little bit of a stretch ahead. So thinking about that, thinking about that paired with, do we have a structural low yet, as an anecdote, right? Just one anecdotal data point. Even if you removed this anecdotal data point from FedEx, has the data we've looked at so far support more of a bottom, or does it support more of a trend continuation sideways move, counter trend, lower highs possible? Lower highs possible. That's the conclusion I've drawn, at least so far. I hope you have too, through walking through the evidence. Okay, now add in the FedEx data point, and it just continues to tip the scales even further, right? We can say bears are over here and bulls are over here. The FedEx data point makes it a little heavier on the bear side. So, anecdote or not, we can add that into the mix. Headed into the earnings calendar this week, GameStop, for all of you meme coin, meme whatever traders out there, get your fix. We're not going to be hanging out watching that. Dollar Tree, perhaps, maybe. What else is happening here? This is actually my first look at the earnings calendar. I'm sort of scanning through with you. Lulu. There we go. Lululemon, Lulumelon. I always get it wrong, but obviously when it's on the screen in front of us, we can read Lululemon. We'll watch out for that on Thursday after the close. Abacus Life. Oh my goodness. Oh my goodness. Anybody who comes out to the morning shows knows that we've got the abacuses up in the office. I'm going to have to reach out, see if we can't put together a little sponsorship deal. Abacus Life, ABL, love it. All right, that's really it on the earnings calendar. I'd say you want to watch Lululemon, maybe as a signal for consumer spend, Dollar Tree for consumer spend, and get your fix if you'd like, not on Route 66, but GameStop. Do your thing if you'd like. That's about it. Let's take a look back at some supporting evidence. We already looked at the TLT ratio to the S&P, so we'll move into bonds. Looks like the longer end of the curve is still doing the heavy lifting for Jerome Powell here with all of these in subtle downtrends here. Let's take a look at credit spreads. We talked about on Wednesday the notable retracement, but notice that we're just finding higher lows. To me, this is not what buyers want to see. Buyers want to see like plummet, plunge, equal lows, firm retracements, and we are not seeing that. Little uptick on Friday with the OPEX there. Let's move into HYG in isolation. A little bit of outperformance via some sort of higher high, but that's to be expected. Does not look... I'll take that back slightly. Looks a little bit better in terms of a structural low. Left, head, right, and then what? Higher high. Higher low happening here also. So junk bonds maybe have something to them. That maybe balances out that scale just a little bit further. So maybe instead of as aggressive of a steep line, you have bears still. I'd say the overwhelming evidence still leans bearish, but maybe balancing a little bit with your HYG here, bullish data point. But unfortunately, sorry, we got a stack of data point right back for the bears. The Bitcoin chart is still underneath the overhead supply. The Sailor Shift tool is still red. Another one, 4-hour bears, is the total breadth of the market. A little bit of an uptick here, but still underneath the 50% mark, and a downtick out of new highs versus lows. It's not looking promising from that point of view. RSP lower high here, breaking down underneath and rejecting for a close below 174 on Friday. Moving into the QQQE, it is the same story. Play me the saddest song on the smallest violin. You have a lower high breaking down. Friday, yeah, it didn't get that follow through on the gap down, but not really seeing a big push to the upside, so I can't say with confidence that a breadth expansion rally is underway here. Volatility is collapsing. It's got to be bullish, Matt. Not so fast here. VIX is sort of a terrible measure these days of volatility, but let's continue through our metrics. Let's take a look at the VVIX. Oh, look, Matt, VVIX is even breaking down as well. Well, VVIX is volatility of volatility. So, of course, when the VIX makes a larger downdraft, it's going to come in more aggressively on the VVIX. But the trick we have up our sleeves is taking a look at this screen over here. And what you'll notice is, yeah, we're ever so slightly out of backwardation. We're just a hair out of backwardation. You can see that here as well. But the one-day VIX has not backed off to its floor. Remember that after these big spikes, which really led to more so capitulation, you saw a full retracement into the floor at 745. We have not seen that on this push. This still, to me, seems like volatility is in the air, and it's just a matter of time before things unwind again. If we go to the trade tab and head over to the VIX, just to show you the volatility curve, you can see here that we are technically in a contango, but we're in maybe a concave contango versus a convex contango, where there's much more steepness in the front end of the curve. The reason that this is important is because if you take a look at the actual contract, so just use this box right up here, if you take a look at this, 25 days from now, market's seeing 1927. You go out to 88 days, and the market's seeing like 1942. Is that a really big contango? No, not at all. I mean, the market's one headline away from flipping back into a backwardation, basically. All it's going to take is a tweet about tariffs, something about something, maybe, who knows what it is. That's, I guess, nobody will know what it is because, of course, it has to be sort of an exogenous event, some sort of unknown, a black swan, but the futures are not in some sort of steep vol curve where it's like, okay, we're fine. The market's pricing out more risk in the future. It's like, no, we're pretty flat in the front end. So I wouldn't say that volatility has collapsed in any meaningful way when the curve is like this. Concave if you're looking from here, convex if you're looking from here, so on and so forth. But you get the idea. The curve is not steep enough. Let's go back over to our core list of companies. Let's get the job done. Volatility's in the air. The market's still leaning a little bit more bearish than bullish. It does not look like we have a structural low. Let's kick things off with NVIDIA. NVIDIA, what do we see here? Is it possible that NVIDIA has a little bit of a low over 114? Maybe. I would still think that the trade idea here is that we still have highs, lower highs, lower highs. This is a possible lower high. It's underneath. It's do or die zone. All the overhead supply at 129. I'd still maintain a little bit more of a bearish stance. However, much more of a balance into the end of last week, so I think we have to be patient here. I would not jump the gun on NVIDIA one way or another until we're over 121, rallying higher, or under 114. Balance rules here. Is it possible that this to this is a higher low? It absolutely is possible. So we'll keep an open mind to that, and that's why I'm really labeling this as a balance range. Let's take it one step at a time. The overwhelming trend to me would seem to indicate that this is probably a better idea than looking for some sort of big rally, but because this has the potential for a higher low, if we go sideways and Brigade bolt over 121, that's the level I would use. Hopefully on the hourly chart, you can see why. This is your range. This is thin structure. If you were to get price acceptance over 121, you're looking at some movement in the upward direction. If you were to get some price acceptance underneath 114, what do we have here? A little bit of a gap. So you've got a helper level at 110.85, but ultimately, full rotation would be back down to 104.75. Let's take a look at Microsoft. What's going on with Softy? End of day on Friday. Interesting little OPEX pop there. You can see the substantial inflow on volume. However, where are we from a trend point of view? It still looks like nothing more than a bear flag in the context of a downtrend here. If you break the highs, we're open-minded to like this taking place. That's fine. You have high, equal high, equal high. You can only knock on the door so many times. So if we go through, we'll respect these helper levels, but ultimately this is the next big rejection out of Microsoft at the weekly key level, 403.25. Any consolidation in here leaves a bit to be desired. I would really start looking for breakdowns, not underneath 385.50, but 382.25. Here's the hourly to show you why. If we look at this previous range, market tried to get acceptance underneath, kind of failed. Market tried to get acceptance underneath, OPEX funny business. So depending on where we open on Monday's session, up here, consolidation. Down here is like, okay, lock and load, prepare for the short, something that looks like this. Right, that's underneath 382.25. That's why I would use that level instead. Apple, what's going on with AAPL? We have ourselves a bullish engulfer technically on that Friday session. Some OPEX funny business once again. That's fine. We trade the charts at face value. Don't get too hung up on the OPEX thing. Over this, I think that the buyers maybe have some sustained counter trend ability over these equal highs is interesting at 217.25. Next helper level at 221.85. Then this is what? Lower high, bring it on home, right? We're not out of the woods. This continues the downtrend, something along these lines. Let's not forget about that. Let's not forget about risk reward back down to the equal lows. If this does retrace, if we open really funnily underneath 214.15, doors are open for lower, 206.50, below that 199.25. Anything, interesting on the hourly? Not really. Yeah, nothing really interesting. Consolidation and go. This is like funny business. We'll be open-minded to this, and this is where it's rock and roll down to the next level. Next up, Amazon, Nancy. We could stay on the hourly chart here because this is really just a balance range. I think it's very clean to see on the hourly. We saw look below and fail. That's complete. Hit the top end of the range, literally at the midpoint as of Friday's close. Patience play. Nothing to do here until we either get this to the upside or this to the downside. You have $192.25 and $200.25. Next up, Google, staying on the theme of the hourly time frame chart. Here's your consolidation, maybe left head, right shoulder. This actually starts to probably look more like a mosquito pattern. Yeah, on the daily time frame chart, more like a mosquito pattern. There's our proboscis. If we were to take out the neckline, we are looking for a gap close. This is a gap close over here at 171, give or take, and then the top end of the range daily 200 at 174.50. That is what we have out of Google. Left, proboscis, right, neckline, 166.35. Next up, Metaverse. What's going on with Zucchiniberg and his Fantasyland? Big rejection of that 607.25. Perfect, as a matter of fact, on that Thursday session. Let's go take a look on the hourly. Here's the double bottom we were talking about as of the Wednesday close. The possibility was for a look below and fail, targets the top end of the range, but go watch the video, watch the Wednesday update video. I said with respect to 607.25. That's exactly where we rejected, so great. Next steps for this name, to me, is just, okay, we've seen a lower high rejection at the trend line, so to speak. It's still in a downtrend. This is the lower high. These are equal lows. If we get consolidation near 577, I would start thinking about a breakdown. This is the first real test of the daily 200 SMA, so the fact that we would get back down there and set an equal low, probably not looking for it to hold. First test, best test. Second test, really looking for it to go through. Should probably come up with a clever jingle for that and trademark it, but you get the idea. 577, start walking down the levels in here. If it's going to be a long trade, I don't think I would long 586 again. I would really want to see this. I would want to get up and over that upper wick from the Thursday session. Trying to trade into that long on the daily, very, very hard. Very, very hard into 607.25. So I would prefer that for some cleaner air to breathe overhead. 635.25 to target. Tesla. Getting some hate out there in just the world in general. It's kind of, I mean, not incredible in a good way, but it's just insane to think about what's happening. Tesla, wouldn't want to own one right now. For no other reason than like, geez, don't attack my car. Don't light my car on fire. What did I do to you? I didn't do anything to you. Double bottom, neckline. I think it's time. It's been building out a base as the market's been continuing to move in the downward direction, namely through this segment back here. I think over the top, you can think about it this way too. This is all a container bar, this large red bodied bar expansion of range. So in here over the election gap low, equal low, the election gap low, if I just scroll back out, you can see this is the election gap. If we get back above that, I think that an uptrend can start to build out off of a structural double bottom. When we're talking about the same concept on the S&P 500, this is exactly what I mean. You have a low. This is a higher low. It's nuanced, but it is there. You bring in a higher high, and suddenly I can't really maintain that bearish stance if we have all the components of an uptrend. The higher high then gives way to the next higher low, so on and so forth, and we just look for structure to see if it builds in the upward direction. So Tesla, really interested in 254.50 as we head into the upcoming week. Nice break, clean over the Thursday high, closed over the Wednesday high, over this. I mean, just a much stronger looking move here out of Tesla on Friday. OPEX aside, whatever aside, I like the structural low that's being built out. That's my take. That's my take on Tesla. We also should remember that there's a weekly zone, that if we were to get over that, that's pretty compelling as well. You set some sort of structured bottom, you accept back above, so a little bit of an overshoot from a weekly or monthly perspective. Great. Looks pretty good to me. So watching Tesla very closely. Those are the numbers. You've had plenty of time to see them. Let's move along to JP Morgan, what's happening with financials. We talked about the XLF chart having the opportunity to set a lower high. This is one of those reasons. Continue here, reject 248. Top end of this is the election gap up back here. Sayonara. Looking for a just trend reversal. Pretty fairly straightforward out of JP Morgan financials. Lower high here, lows, lower lows, big time lower lows. Lower high can happen anywhere underneath 258. So hate to be that guy again, but there's no hourly uptrend for a counter trend lower high to be set in this entire leg of the move there. Let's move that off and take a look at Netflix, and we'll get 4 trade ideas for you today. Netflix is interesting because of the way that it's built out this range here. It's got this neckline of the head and shoulders, of course, which to me should have offered a stronger rejection point in here. So that's a little bit of a head scratcher if you're trying to maintain a bit more of a bearish stance on the market. This would be one of these instances where I think, okay, there's a great spot for a lower high to form here. It's not happening. Maybe the bears are just done. Maybe the bears are done. This is much more of an emotional capitulation style bottom. So the V-shaped recovery strikes me as being a little bit more acceptable concept-wise, theory-wise, than the S&P. Regardless, as we walk into this week, it's got to be up and over the equal highs at 966.85 into 999. We'll watch that. Or if it's consolidation here underneath 950.25, I would just step back in on the short side, honestly, being underneath the daily 50, underneath the neckline. In theory, if the broad market's also bearish, that would act as a tailwind and push prices lower also. That's Netflix. Let's take a look at the first trade idea, app lovin'. What's going on with app lovin'? This could be played 2 ways. I would use the broad market as your key to whether or not this is a long or a short. You absolutely have ascending triangle happening down here, but is it just a bear pennant? That's for us to decide based on the broad market. You have this as overhead supply, possibly weighing on prices here, but notice that you tested it, and when you backed off, you clearly came into a higher low. You're back to an equal high test, and I think if we break over 312.50, you could easily target something like 337.25 as a day trade. I'm not talking about this through the lens of a multi-week swing opportunity, but I do like it from an intraday trade perspective. You can see the clean higher low happening here. You could probably afford to just pop in a trend line and do something that looks like that. Awesome. If we get this rotation, I think there's the opportunity for risk and reward on something like a day trade. That's 312.50 into 337.25. If you're like, how could you talk about a bullish trade here if you were just so bearish about the broad market? That's fine, but wait for a trendline break here, and I would probably start thinking about the equal low being the first attempted target somewhere in here around 278 flat. You guys know me up in the penthouse office, round numbers only. Let's fix that together, and then we'll move into the next one. That's app lovin'. APP is the ticker. Next up is going to be on IBM, coming back from the graveyard. IBM. What do we see over here? Daily chart is where we're going to begin. Notice that we have this previous pivot high. We have 2 back-to-back hammers, longer lower wicks, an inside bar on Friday. If we can break out over the top end of the two equal highs here at 245.50, I think there's a nice trade intraday as a move into 253. Let's take a look now on the hourly. You can see it's straight up, it's straight down, it's straight up. In theory, we can go straight up through that thin structure. 245.50, 253. This, of course, wants to see some sort of Brigade bolt, risk, reward for the upside intraday. Matt, it's the same thing as AAPL. Of course it is. It can also reject the overhead range here. If the broad market is bearish, I wouldn't take the long trade. If the broad market's clearly bearish and we're also seeing tech crumble, I would say watch for your inside bar breakdown to close the gap below. Meant to have a yellow level down here. That is fine. Let's do that together. Look for the gap close. There's nothing here under 238 into 229.70, and you could take the short just like you could in AAPL, IBM, gap to close underneath, thin structure, nice opportunity. Let's move along to another one. Let's go to PLTR, Palantir. Let's take a look at the fan favorite. Let's see what's happening over here, and lo and behold, we have the structural elements in place for an inverted head and shoulders. We are over the 50 SMA, and we have thin structure to retrace to our left. If we can get this, I think there's an opportunity. This one might be a multi-day trade versus the others that I'm thinking much more along the lines of day trades on. So it doesn't mean you can't scalp it, of course, over 90.75, but that's sort of the opportunity in the chart that I'm seeing. Inverted head and shoulders out of this range after failing to break down here over the 50 SMA. Show me the money through the thin structure retracement. Palantir looking pretty clean here. On the hourly chart, gets even cleaner. Right, you can really start to see some of these bottoming formations in there. Looks good. 90.75 will be a top watch early on in the week. Last but not least, I've got Datadog. Let's go Datadog for you. And let's take a look. This one is a counter trend based on the same premise. Really extended move to the downside, bear flag consolidation. So you had leg 1, you had leg 2. If a bottom is going to form here, then what do we want? We want this. I would not consider this one a new money short down here on the lows. I think it's past the point. You're shorting into a hole if you decide that you want to short Datadog at 100. Could I look back at this in 10 years if the stock is trading at 15 cents or whatever and say, wow, what a stupid comment that was? Sure, of course I could. But from a trade management, risk management perspective right here, right now, I would not take the counter side, or not the counter side, but the follow through side out of Datadog, whereas I would out of things like IBM and App well before I would short Datadog into a hole. Let's go down to the hourly chart so we can see this. A lot of the reason why I choose some of these setups is because we have easy, air quotes. Remember, everything exists on a spectrum in trading. We have difficult and we have easier. Easier, thin structure to retrace means that if this move is going to unfold, we probably fall somewhere over here on the spectrum versus the hardest trade we've ever taken. Oh my God, it's so stressful. It's a nail biter. We don't want to get involved in that. So I like the thin structure retracement. If it's going to happen, left head, right shoulder, whatever, over 104.75, helper 107.50, and then 110.75 is the ultimate target. That's it. That's what I've got for you in this weekend's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember that we will be live every morning for the pre-market prep at 8 o'clock Eastern time. We hope to see you there. Had some fun last week, especially with the Jerome Powell stream. We do some special stuff every now and then. If you made it to the end of the video, again, drop a comment down below, and we hope you have a green trading week. With that said, I will see you in the next one.